market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, pump prices keep rising, but President Trump is defending his strategy in the Middle East. Now, we discuss what it means for inflation and monetary policy with Jari Stehn from Goldman Sachs in just a moment. But first, Apple posted a surprisingly strong revenue forecast for the third quarter. The tech giant projecting double-digit sales growth, even as it warns of rising memory chip costs and ongoing supply pressures. Well, joining us now is Matt Blockson, senior analyst at Bloomberg Intelligence. Matt, always good to speak to you, especially on a Friday morning. So what stood out to you in these results and the guidance that they also issued?
Yes, I mean, also that guidance in itself is pretty robust, of 14 to 17% year-on-year sales growth for the forward quarter. The market was looking for about 9%, and that's on the back of a strong quarter they just reported of 17%. So I think what we're seeing is very resilient demand for Apple products, even though the iPhone sales were only in line with expectations. It was a pretty full expectation. So the iPhone remains incredibly popular with the 17e just launched and huge success on the Neo. There is this kind of slight cloud on the horizon about rising memory costs, which didn't really hit the March quarter numbers so much, but they did clearly signal that it would become a bigger impact going forward, but probably only going to really impact certain parts of the product line. For example, the Mac Mini, which is being hugely popular for AI workflows.
So, I mean, overall, the outlook appears, pretty encouraging for John Turnus, the incoming chief executive. What are your expectations in terms of leadership transition or, just leadership in general as the transition approaches?
Yeah, so, I mean, he obviously inherits an incredibly strong company, but there are a number of issues that do need his attention, most notably being their AI strategy and the overhaul of the Siri platform, which is, been dragging on. So that's one big thing. They've also got some big product launches coming in September with most likely the first foldable iPhone, the iPhone Ultra. And then he has to think about, the kind of the longer term view about what is the next form factor for consumer devices as AI takes hold, and how is Apple going to take a leading role in that innovation. I think arguably they've been a little bit kind of a follower rather than a leader in some ways recently.
Matt, thank you so much for the terrific briefing. Matt Blockson there, and of course we continue watching all tech stocks. Matt is our senior analyst at Bloomberg Intelligence. Now, President Trump says the U.S. blockade of Iranian ports is, quote, incredible. But the stalemate in the Strait of Hormuz continues to shape global energy markets. Well, let's bring in Bloomberg's Charlie Wells with the latest. Charlie, I mean, this is a problem for prices at the pump.
That's exactly right, Francine. These geopolitical tensions are really hitting that oil market. We can see the price of oil is up some 25% over the past 2 weeks. So that is a significant jump as it continues to hold these gains. And again, this has been a market story. It's turning into a corporate story. And now it really is starting to turn into a consumer story as well. So let's flip and look to see where this pain at the pump is hitting across the United States. Because you can see divergence here, right? What we had this week is in California, prices at the pump heading north of $6 a gallon for the first time since 2023. So a big jump there. You see divergence across the country, but you see increases. Now, what's really interesting, if you want to think about the consumer and you want to think about politics, look at the states where we see this strong red, where you see these big jumps. Those are typically blue states. These are states that voted for Kamala Harris in the 2024 election. If you look at some of these blue, some of the kind of weaker jumps in gas prices, these are states that voted for Trump. You might start to think that this might not have such negative implications for the midterms that are coming up in just a few months. But let's flip the board and take a look at some analysis coming from Bloomberg Intelligence talking about how actually it's these red states, these states that voted for Trump that get hit hardest on a percentage basis. Because when you look at how household expenditure evens out, you see more spending in these states on gasoline at the pump. So again, a hit in those states of as much as 70% there. So again, serious implications for the consumer and also politics as we head towards these midterms.
Charlie, thanks so much for the terrific briefing. Charlie Wells there with the very latest, of course, on these rising oil prices, what it means for voters in the U.S. Now, the Fed, the ECB, and the Bank of England all holding rates over the past few days. Let's get the thoughts of Jari Stehn. He's Chief European Economist at Goldman Sachs. Jari, as always, thank you so much for joining us. Okay, so three big central banks, but actually the message was quite different. They're in different cycles, and they're also vulnerable in different ways to higher oil prices.
Yeah, I think that's right, and that was to be expected, of course. The Fed is still more in the camp of seeing whether holding or cutting is appropriate. Yeah. There was obviously quite a debate around whether to keep an easing bias or not, with a large number of dissents. I would say the ECB on the opposite side of that spectrum, I think signaling pretty clearly that higher rates are coming. So I think a June hike now looks really quite likely. And then the Bank of England, we would say somewhere in between, with some indications that rates might rise, but then also Governor Bailey saying that the options remain open. And so I think a healthy range of communication this week.
Jari, I think we mentioned this before. I mean, does the Bank of England have a problem because actually interest rates are just so much higher than the ECB? And so I understand there are different economies, but at the same time, it just puts naturally, at this moment in time, the BOE at a disadvantage.
Yeah, I think it matters where you start. And we think rates in the UK are still restrictive. Bank rate is at 3.75%. Our estimate would be for the neutral rate of around 3%. So you're coming into this with a restrictive stance. You also have a weakening labour market. The unemployment rate, of course, has gone up. Long-term interest rates have gone up quite a bit. Financial conditions have tightened. And so I do think the hurdle for them to hike further on top of that is higher than, for example, for the ECB, where we think you're going into this with a much more neutral setting for interest rates. I
mean, at some point, the number of hikes that the market was expecting was it out of control? I mean, at some point, it was like 3 or 4 hikes this year, which would really put the economy on its knees.
I think 3 or 4 hikes would be excessive as an expectation at this point. So our baseline actually is that the bank holds through this. Yep. Now, I think that's a close call whether they hold or they do a couple of hikes during the summer. But that doesn't get you to 3 or 4 hikes. So I think that would really require a combination of more intense pressures from the energy markets. Of course, it's possible, but wouldn't be our base case. And then I think also signs of strong pass-through, not just into headline inflation, but also into wage setting, into services inflation. And all of that is possible, but that doesn't seem to us like the most likely outcome because the labour market has weakened. Rates, as I said, are restrictive. And so I think we'll get some inflation pressure, and possible they lean against it a little bit, but I don't really think it requires a proper tightening cycle from the Bank of England. I
mean, everybody remembers 2022 and what happened there with a lot of central banks being a little bit late to the game. I mean, this also feels like a different situation because it's a much bigger energy crisis than what happened in 22, which was Russia-Ukraine. Is it right that central banks wait a little bit to see more data before they decide? Like, what would a real policy mistake look like today?
Yeah, I think it's right to wait longer, and the differences you mentioned to 22 are important. Central banks are going into this with a more normal level of interest rates. They don't have to do that sort of catch-up that they had to do in 22. Labour markets are not nearly as overheated as they were in 22. If you think about the post-COVID bottlenecks in the labour market, the reopening, I think that's very different. Fiscal policy is not nearly as expansionary as it was in 22. And then I would also say the shock itself, the energy shock is big, but it's not as broad as it was in 22. It's energy, it's not food, and we're not seeing the same type of supply chain disruptions in goods markets, for example. And so I think it's right to go into this and say we want to see a bit more data, and that's really what all of them have said. It's just that we think the ECB is closest to actually pulling the trigger because they are starting neutral, and I think for them to go a bit restrictive here is defensible. Yeah. At the same time, we don't think that these higher rates will be sustained for very long. Right. So we have the ECB cutting a couple of times, but we actually have them, hiking a couple of times this summer, but we have them cutting back next summer because you are hiking into what is a pretty weak growth environment. So I don't really think it needs the sustained level of restriction that we saw in 22. And that aspect is not priced by financial markets. We're pricing these hikes, but they're not unwound. And I think at some point, I think markets will come to that view.
I mean, is it too alarmist to say that we could be seeing the first, green shoots of stagflation? Because stagflation is the one thing that nobody wants to be dealing with.
I mean, we will certainly see weaker growth higher inflation.
Yeah.
I mean, whether you want to call it stagflation or or not. I mean, President Lagarde said that's a term for the 70s. But it's certainly what we're seeing in the data, even over the last couple of weeks. The surveys are weakening. We're also seeing, both in Europe and the US, that the Q1 GDP data, so the pre-conflict data, was actually also a bit softer. So we have cut our growth forecasts quite significantly, especially in Europe. And at the same time, the inflation indicators are going up.
Yeah.
I think on the headline inflation side, it's really not a surprise at all. This is pretty mechanical by energy prices. But the key question really is the feed through into core inflation, into supply chains, ultimately into wages. And here we don't have a lot of evidence yet. We think there'll be some pass-through, but a more limited pass-through than in 22. But that will be the key issue for central banks to watch.
Yeah, do you worry that actually markets, especially equity markets, are focusing so much on tech and some of the tech valuation and the capex spending that have been above expectations that they're not pricing in correctly a possible downturn in the economy? If you look at all of the geopolitics that we're living through, I mean, there's no real good outcome where there's a permanent ceasefire in the next couple of weeks that would allow these oil prices to go down.
Yeah, it is an interesting comparison and to some extent disconnect that you have all-time high equity prices in the US, and then you have significant concerns around energy supply and still upside risk, we think, on energy prices. And our equity strategists do think that the tail, the sort of left tail on equities at this point is underpriced. You can make a very reasonable argument that these valuations are justified, given the AI story, given still pretty solid growth in the US, and then also the fact that some of the valuations had come down. But to us, it's a little bit more about the distribution. Yeah. And as you said, there isn't clarity in terms of how the energy situation will evolve. And I think until then, we do need to keep, a bit of an open mind about the downside here as well.
Jari, just very quickly, I mean, after the communication from the ECB and the BOE yesterday, do you expect a hike in the summer?
So we do expect a hike from the ECB. We expect two in June, September. I think that's been pretty well flagged. Risks around that, I think, at this stage go in both directions. If energy prices fall significantly, then they could still hike. If energy prices rise more, if you get more pass-through effects, they could do more than two hikes. So I think that's relatively clear. For the Bank of England, I think it's a little more uncertain. We read the communication yesterday, particularly from Governor Bailey, as really leaving options open at this point. Our base case is that they hold for the reasons we talked about, restrictive rates, weak labour market. But I think that's a pretty close call versus delivering a couple of hikes. And so I think we really need to see for the bank how the energy price pressures evolve, how the inflation indicators evolve, how the labour market evolves. I think it's a little bit up in the air still.
Yeah, and hopefully we'll have a little bit more data from now until then. Right. Jari, thank you so much for doing this. Jari Stehn, nice to see you. Chief European Economist at Goldman Sachs. Now, coming up, we'll also discuss the pressure building on both the US and Iran as the war enters its third month. Phillips O'Brien from St. Andrews University joins us next, and this is Bloomberg. Well, President Donald Trump says he's sticking with the naval blockade of Iranian ports amid concerns that the vital Strait of Hormuz will not reopen anytime soon. Let's bring in Bloomberg's managing editor for the Middle East, Onur Axios, reporting that President Trump has been briefed on new plans for possible military action against Iran, with language hardening on both sides. Where do we stand this morning?
Well, the impasse as of this morning continues. On the one hand, we have President Donald Trump, as you said, reiterating his intention to keep the blockade in place. He said that the restrictions are preventing the Islamic Republic from exporting oil, and that's depriving Tehran of much needed revenue. On the other hand, we are seeing no indication from Tehran that they are ready to reopen the Strait of Hormuz, which they think should should be preceded by the U.S. lifting its own naval blockade. That basically leaves us where we were pretty much about 3 weeks ago when the ceasefire was first announced. Both sides want the other one to act first, and as the impasse continues, we're seeing signs from Washington that Trump is again considering, or at least looking at, military options, which according to Axios may be aimed at breaking the deadlock with a possible sudden and short but intense wave of attacks on the Islamic Republic.
Honor, OPEC meets on Sunday without the UAE. How much attention will the market pay if there's another symbolic production hike?
Well, when it comes to OPEC and the UAE's recent decision to quit the oil-producing group of countries, it really is hard to see what kind of action from OPEC or from UAE from here on can make an immediate impact. At the end of the day, all we're talking about when it comes to production and UAE's decision is kind of hypothetical at this point. Without the reopening of Hormuz, anything that OPEC member countries are going to say about production remains hypothetical and can only have an impact on oil markets once there is an eventual possible reopening of the waterway, Francine.
Honor, thank you so much, as always, our managing editor for the Middle East, Honor Aunt. Now let's bring in Phillips O'Brien, professor of strategic studies at the University of St. Andrews. Professor, thank you so much for joining us this morning. There's no clean way out. It seems that both sides are becoming more entrenched. Iran yesterday was saying, or at least, the leader was saying that they absolutely need to not get rid of, some of the nuclear options of enrichment, and the U.S. will continue to blockade. What is the way that we de-escalate this?
Actually, I do wonder if Trump's needs for victory conditions have narrowed a lot, and there is more of a way out, but the Iranians right now don't seem to be wanting to go down that road. That if you listen to the administration closely over the last week, all their victory conditions have gone except one. They want a major nuclear concession by Iran, and that might even not be that much in terms of substance. It could just be a stylistic concession. But they need a nuclear concession. That's all Trump is talking about. That's what Rubio and what Hegseth are talking about. If Iran is willing to give the administration some kind of, it might even, as I said, just be a loose concession on nuclear power, which make it look like Iran won't have a nuclear bomb, it could be settled. So in many ways, it's a bit up to Iran right now what happens, and the Iranian regime, from what it looks like, doesn't want to make that concession, but that's not to say that it won't.
But, Professor, what I hear from all sides is that actually there is no trust. So I don't understand what would bring Iran actually to negotiate seriously if they don't trust the president not to go back on his words.
Then they would never negotiate. I mean, in some ways, negotiations are happening between two powers. I mean, the Iranian regime has been hit. It right now doesn't seem to want a deal, but we don't actually know its real condition. And if they could get, for a fig leaf concession to Trump, if they could get a breathing space to consolidate power and start getting more income in, they might take. I mean, this is all subjective, but it's just to say that there will have to be a deal at some point. It's whether now there could be a deal before going back to escalation or before waiting many months or weeks for a blockade to hit. I'm not saying this is likely. I'm just saying we are now to the point where there is only really one victory condition left for the United States because they've failed in this war. And if Iran is willing to give the Trump administration that victory condition, even as a fig leaf, the Trump administration might take it because they want out of this war.
Professor, what happens to the Strait of Hormuz? Who would control it? Is this still on the table? There's no clear way out today, but also once there is a negotiation, what happens to it in 3-4 months?
Well, that's what's interesting is that the Trump administration has talked less about control of the Strait of Hormuz in the last few days than they've talked about a nuclear concession. So it might be that the Trump administration would allow Iran to maintain some control over the Strait of Hormuz as long as Iran reopens trade. Because that's a real problem for the Trump administration. They can't open the Strait of Hormuz by sort of clicking their heels and saying open up, because really the Iranians control it. And they can control it with very simple weapons and cheap weapons. So it might be that this is the kind of thing where the Trump administration doesn't make a concession to Iran, but leaves it quiet, accepts a nuclear kind of deal, and Iran remains in control of the strait on the assumption that trade opens up.
Professor, how crucial is the next couple of weeks? I don't know whether there's someone that you would watch from the Trump administration side to look to whether there are any signs of progress.
Well, it would be actually watching the Iranian side, because they're the ones who are in control of this right now. The Trump administration, as I said, they want out. The president wants to get out of this. He just needs to be able to declare victory. So the Trump administration has been actually in some ways quite clear in the last week about what they want. What we don't know really is what the real condition is for the Iranian government. So I would watch what the Iranians do and see if there is any wiggle room on their side to see if this is going to end relatively soon or whether it's going to stretch on. If Iran doesn't want it to end, it's not going to end because they control the strait. So it doesn't matter what the U.S. government wants as long as the Iranians want to keep this going.
Who has the best intelligence on Iran right now? How much do we understand about the strength of this new regime?
That's a great question. I don't think American intelligence has been very good on Iran to this point. They really did seem to think that if they killed the government, that they would get a government in place with which they could deal. They don't seem to even have now a great deal of knowledge about the internal condition of the Iranian government. My guess is the people who have a better idea about this are the Russians and the Chinese, who are closer to the Iranian government and actually, from what we can tell, are increasing their support for the Iranian government. So they might have a better idea about the true condition of what's going on in Tehran. And it is notable that the Iranians have reached out recently and made a very public showing of support, received a public showing of support from Russia. Trade from China is up. So I think that actually is probably where a lot of the power in this lies.
Yeah. Should we worry, very quickly, Professor, should we worry about China potentially giving more support to Iran?
Well, I think that's what the Iranians want. I mean, the Chinese are probably going to do what they consider in their best interest. They certainly don't want the Iranian government to be overthrown by a pro-Western government. So we should worry about it. But actually, there's not a lot that we can do about it. The United States has, it's gone to bombing. It's tried to destroy the Iranian government, and as of now, it's failed. So it can try and intimidate the Chinese. But by the way, the United States has lost its military levers over China. That the United States has shown it cannot fight a war in the Western Pacific, that it doesn't represent that kind of military threat to China that people perhaps thought it did represent.
Thank you so much for joining us. That was Phillips O'Brien, professor of strategic studies at the University of St. Andrews. Coming up, President Trump says he plans to remove some tariffs on Scotch whiskey following the visit of King Charles. More on that next. Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. Oil prices head for a second week of gains, but President Trump defends his policy in the Middle East, saying the Iranian economy is a disaster. Apple tops estimates, a boost for incoming chief executive John Ternus, but the company warns about higher costs of memory chips and shortages of Mac computers. And Japan intervened in the currency market for the first time since 2024, but some traders say more action could be needed. So President Christine Lagarde has signaled the European Central Bank will consider a possible interest rate hike in June after policymakers debated and rejected the idea on Thursday. Well, Lagarde says the euro area is moving away from its baseline.
Directionally, I know where we're heading, okay? But we shall see. There might be massive changes taking place. There's one element that is going to have a real impact, and that is the duration of the conflict.
That is, of course, the ECB President Christine Lagarde. Now, the Bank of England has voted 8-1 to keep rates unchanged, with the chief economist, Hugh Pill, the single dissenter, calling for a quarter-point hike. Now, the governor of the Bank of England says that was perfectly understandable and played down the differences in opinion. Now, Andrew Bailey also told us the central bank is concerned about the impact of inflation on consumers.
Well, inflation expectations have picked up. Now, of course, they do tend to follow the shorter end, 1 year ahead inflation expectations tend to sort of follow what inflation is today. But look, we're also obviously sensitive to the fact that people's memories are important here. They remember the fact that we had high inflation 4 years ago, so that also has a part to play in this. And we do take it into consideration, obviously.
Governor, I mean, overall, the markets largely see today as dovish, yet your own chief economist was pushing quite hard for a hike. So is it odd having a dissenter coming from the BOE's own office? Well,
I wouldn't particularly say it's dovish, but obviously that judgment has to be relative to what what people thought we were going to do. So I respect that point. And we have been somewhat pushing against, I was pushing against the curve, as you know, 5 or 6 weeks ago, probably now. Look, I think Hugh Pill's position is perfectly understandable. I didn't vote with him. I didn't agree with him on the end decision, but I understand the point he's making. I would also say, and Hugh wrote this in his paragraph, that he used the word modest, and I think he used the word modest very deliberately. I mean, he'll speak for himself, but I think that word is deliberately in there. So the differences between us are not that big. What would it take for you to actually to vote for a hike next time? Well, I think we sit down and go through all the evidence, and I think what it will take is, and we laid out sort of some of the things we'd be looking at, is both quantitative and qualitative. I mean, I think what we get on the qualitative side is going to be important because, we'll be talking to a lot of businesses saying, how are you approaching passing these cost increases through? What are you seeing in terms of demand for your, whatever you produce or provide? It's going to be some time before we get a real read on wage settlements because there's quite a seasonality to wage settlements in this country, and we've passed through peak season, which is earlier in the spring. So it's going to be a while before we get a really probably any big read on wage settlements. But we will be looking very carefully at what people are planning for. Those settlements that are coming through, that will be important as well.
How big is the risk of a technical recession at this point?
Well, most of the scenarios we have actually, and against most of the interest rate paths, actually suggested this is a story of slower growth. In the more extreme sort of difficult scenario, with some policy, you can have a variety of policy responses. There are some quarters of negative growth, but this is actually interestingly not, as we see it today, at least, a story of dominating, it's going to be a recession. That's not the dominating story at all.
But Governor, I mean, so far you're happy with the market reaction, and also, I mean, next week is a big deal in terms of, the elections in parts of the UK. Could that be a market event?
I think the market's reaction so far today is very sensible. Look, on the UK side, I don't comment on UK politics, obviously, but what I would say is this. The things that I think what we've seen in the interest rate curve has been dominated by the Gulf. Mm-hmm. The things I look for in terms of when I try to sort of break down what's influencing this, has the exchange rate moved? No, not much at all, actually. Have we seen much movement in short-run sterling swap spreads? No, not much at all. In fact, it's a bit tighter than it was before the budget last autumn. So that suggests it's really actually it's a Gulf story, I think.
Governor, I mean, the final question is the NISR warned this week that rates could go 150 basis points higher if the Middle East crisis worsened. I mean, can you see any scenario where that would happen?
Well, look, there are really bad scenarios in this. I mean, if we get cut off of energy supplies going on for a very long period of time, bad things can happen. But it's not in our. It's not in our central decision today at all.
But this is what, a 10% chance? So
I'm going to avoid it because I think that the world is so unpredictable at the moment. So we've seen it today, let alone over longer periods of time. The world is so unpredictable that I think putting sort of precise, percentage probabilities on things is put it politely, hazardous business.
Well, that was the governor of the Bank of England, Andrew Bailey, speaking to me yesterday after the press conference. Now, President Trump says he plans to remove some tariffs on whiskey following the visit of King Charles. Well, Trump says he would remove the restrictions so that Scotland and Kentucky can start dealing again. The U.S. bourbon industry exports used casks to Scotch producers. Now, for more, I'm joined by Bloomberg's James Woolcock. James, I mean, this was a visit that had to go well for King Charles, and it went very well. Did he charm the president?
Clearly. I mean, everyone has, in my inbox at least, been talking about a big golden bell that the king dug up from a 1940s warship called HMS Trump, which still has the Trump name on it, which is a British ship that he gave to the US president. Now, the deal is big news. It's roughly $1 billion of UK exports to the US. The UK is also the US's second largest export market for bourbon. So, look, it's good money. But more importantly, the president is playing favourites. The UK Prime Minister has been frequently attacked in the past few months by Donald Trump. But it just goes to show that UK has another asset, soft power. And you can send the royal family with pageantry and pomp and great speeches. And you can get something from this US president.
I mean, do we have any idea of how long, I guess, this, friendship or likeness lasts? Because, and you're right, King Charles, I mean, he was funny. He was, he kind of weighed into politics very subtly, but some of the speeches that he made were very powerful.
Well, it's kind of also Charles who was responsible for the initial US-UK trade deal. If you remember, Keir Starmer went to the Oval Office with a letter from the King. So, in many ways, Trump's love for the royals is very long and enduring. I think, to your point, the difficulty is his hostility towards UK Prime Minister Keir Starmer is also now quite well documented. And as soon as next week, there could be problems there because we look to UK's plans to try and reopen the Strait of Hormuz internationally without helping the US. We're looking at the US president talking about withdrawing troops from NATO in parts of Europe. There are all sorts of issues on the horizon that I think the King will have very little ability to play into. And meanwhile, for the UK Prime Minister Keir Starmer, he's got very difficult local elections coming up as well.
I mean, reading between the lines, there were points where the King did, almost seemed to suggest, look, Mr. President, back off my Prime Minister. Is that fair?
I mean, he's also, by the way, as the head of the Commonwealth, the head of Canada as well. So there are also parts of that there too. I mean, Charles, before becoming king, has long had very big environmental credentials. He's been a very sort of fan of green technology. And so the word we're using is it's punches with a velvet glove. So it's all sort of very hidden behind sort of charm and charisma. But I think the questions will always be when will this trade deal happen? There are still questions about the details of these Scotch tariffs. There's a lot more behind the pomp in sort of the hard economics that we sort of are still tracking and is yet to be seen.
And James, I mean, on these local elections, is it likely that they go badly for Labour, and how do they regroup and rethink?
I think you're being very kind with likely. We had a poll this week, a landmark poll that says of the sort of 2,500 seats Labour are defending, they could lose 1,800 of them. That would be the worst loss in sort of the midterm elections of any UK government in modern history. Yeah. I mean, so that's the definition of badly, frankly. Yeah. That could spark all sorts of problems for Keir Starmer, because what happens is every MP has their councillors. If you use the councillors, they ring you up and go, what are you doing? I've just lost my job, I've lost my salary, I've lost my sort of career. What are you going to do about that? And so that's when the MPs who back Starmer and keep his seat in Parliament start ringing him up and saying, what are we going to do?
James, thank you so much, as ever, for the terrific briefing. James Woolcock there with the very latest on the UK. Now, the yen retreating after its biggest gain in almost 2 years as investors assess the impact of Japan's market intervention. Our markets reporter, Justina Lee, joins us now. Justina, it's so good to see you. How significant was this latest intervention, and are we likely to see, more than one round?
Yeah, we did see a pretty stark reaction earlier today in Japan, with the yen surging 3%, the most in almost 2 years. Now, it's probably worth remembering here that the BOJ really is fighting against the fundamental tide. Because on the one hand, we've had a hawkish hold from the Federal Reserve this week, which is supporting the dollar. And kind of on the other hand, I mean, the BOJ has seemed like reluctant to signal that another rate hike is coming. And so when all the fundamentals are kind of pointing to a weaker yen here, I think if we really want to see some sustained resistance to further yen depreciation, you probably do need more intervention here.
Justina, can they do something on oil markets? Because that's also, I mean, this is a huge problem for a lot of Asian economies, especially Japan.
Yeah, exactly. And that would be a very novel way of dealing with currency weakness. But it does seem like Japan is considering that move right now. I mean, we've had kind of officials signaling that they think that speculative trading in crude oil is something that they're watching when it comes to the currency. And that's because Japan is very dependent on oil imports. And so when oil is higher, the currency naturally weakens. And it does seem like they are considering intervening in the oil derivatives market as well.
So this would be in the markets. I mean, there's no cap or anything like that they could do. I mean, that would be really dramatic. Are you hearing anything of, the more innovative ways of maybe trying to keep a handle on this?
Yeah, exactly. I mean, my colleagues in Japan have reported that the BOJ has spoken to market participants about the possibility of intervening in oil. And I think if we look at the past patterns of intervention, it usually does take, quite a few rounds for that move to really stick. And some people are talking about how, whether the U.S. is going to kind of take part as well. Of course, that would be a way stronger signal to the markets. But that is generally kind of extraordinary, very rare. And so I think people are really kind of watching how Japan is going to fight those fundamental tides here.
Justina, thank you so much. As ever, Justina Lee there with the very latest on the markets, especially on yen. Now, Wall Street's trading desks just capped off a record-breaking first quarter as clients scrambled to hedge against global volatility. Now, while UBS rode that same wave to bumper profits, the celebrations may be short-lived. Well, Paul Davies from Bloomberg Opinion argues these massive gains could actually complicate the bank's ongoing regulatory battles. And Paul joins us now. Paul, thank you for coming. I mean, I love you wrote from UBS yesterday, and then it was US with Jamie Dimon, Barclays, and UniCredit. So we can really go around the world and talk about all the banks. Look, I loved your column on UBS because the general idea is that if you're negotiating with the government that want to, for you to put money to one side, you don't want to be that profitable, especially if shareholders expect a lot of money back.
Yeah, exactly. I mean, the problem this week is that, they did very, very well, and some of the short-term or smaller concessions that the government has given them on some of the capital rule changes that are coming have made it very apparent to a lot of the analysts that actually they could afford another big buyback in the second half of this year. They've already done or nearly completed about $3 billion worth of share buybacks so far. And lots of people are now expecting another $3 billion more. But this is going to be announced, if they announce it, in July, right in the middle of when the Parliament is starting to debate whether they need to hit them with much bigger capital charges to protect taxpayers against the risk of a possible failure of what's now their last very large, globally important bank in Switzerland. So it's a bit awkward.
But it is a little bit awkward. When you look at some of the business models, does this set of earnings actually show you what works and what doesn't? Or is it also a bit of luck of the draw if you're just doing really well on the trading front, given all the volatility because of what's happening in the Middle East?
Everyone's done well on trading this quarter. Unsurprisingly, there's been a lot of volatility in markets. The US banks did better in general, I think, and on average than the Europeans. Some of that is business mix. Some of that is because the US banks do a lot more in commodities than most of the Europeans do. Some of that is to do with just being much more in US markets, which are bigger and kind of there's more activity been going on. And on the investment banking side, they definitely did a lot better in the US. And again, that's to do with where the deal activity is happening to some degree, I think. But it was still very good in all. I guess the issue the thing I realized about European banks this week is a lot of them, in fact, all of the significant investment banks are actually kind of really capping their ambitions in investment banking and markets now.
Why is that? Is that because of the US?
It's to do with their own individual strategies.
Yeah.
They've been recovering and rebuilding their balance sheets for years, and some of us expected them to kind of start maybe gaining share again, especially in trading. Yeah. But most of them have now some kind of informal or formal cap on just how much capital they want to put into banking. So at Barclays, it's got to be less than half the balance sheet. At UBS, it's a quarter. And most interestingly, this week, Deutsche Bank, their new CFO, Raja Akram, who's just joined from Morgan Stanley, he put their private bank and asset management businesses first in his presentation, which is a cosmetic shift in some ways, but it sends a signal. And they now want to build. They had a first quarter where the investment bank provided less than half of profit profits, and they want to build on that, and they want the rest of the bank to provide more of the earnings in the future.
But are we going to be in a situation where it's, the Goldman Sachs's, the JP Morgans, Morgan Stanley's that will come more to Europe and actually try and get that market share in terms of investment bank? And is that not risky actually for European banks if they want to ever build it up again?
I think absolutely. And don't forget they're being helped, or they're going to be increasingly helped by the following wind of a Trump White House that is very keen on deregulation. There is some capital easing going through. JP Morgan, they still think it's going to hurt them more than help them, but then they always do. So there is definitely going to be more expansion. And Goldman Sachs itself was very expansive with its balance sheet in trading in the first quarter of this year. And yes, you're right. Longer term, this risks leaving European companies, completely dependent on US banks for access to capital markets. And that's a lot of the decisions make sense individually for the European banks, but collectively, for Europe as a whole, maybe it's not such a good thing.
Yeah, it's never good news. Paul, thank you so much. Paul Davies there from Bloomberg Opinion. Now, coming up, we'll also talk to Tim Richards, the founder and chief executive of View Entertainment, about the impact of Paramount's Warner deal on the cinema industry. But let's face it, we'll also talk about Devil Wears Prada, too. We'll talk about cinema next. This is Bloomberg. The conversations that matter, the insights you need. This is The Pulse, and I'm Francine Lacqua here in London. Now, the $111 billion Paramount Skydance merger with Warner Brothers Discovery could reshape the cinema industry. While David Ellison, the Paramount chief executive, has pledged 30 theatrical releases per year, industry groups remain skeptical. Now, they point to the 2019 Disney-Fox merger, where consolidation ultimately led to fewer films and less variety for theaters. Well, joining us now is Timothy Richards, founder and chief executive of View, the largest privately held cinema operator in Europe. Tim, thank you so much for joining us. First of all, when you look at all of this M&A background, does the cinema business just remain too fragmented in Europe or globally?
Well, the good news is business is back. And the demand, our customers never left us, but business is back right now. And if you look at what happened with Michael opening weekend, $217 million. Devil Wears Prada is going to be very, very similar. In terms of how, and for consolidation, it is fragmented, and it has been fragmented for quite a while. And I think everyone's been waiting for business to return before they actually took that first step. The contrarian investors are too late. We're back.
But Tim, you need content first and foremost. So we'll talk about ticket pricing and, AI and how you manage queues and stuff. But you need content. Do you worry there's going to be less content out there, less films being made because of the merger?
Yeah, look, I think my biggest concern is demand. And I think we've proven certainly in the last few years that there is a massive demand for all movies of all genres, for all demographics. We've broken records for all kinds of movies, and if you look at Hamnet is going to do £20 million in the UK. Wow. So I worry about demand. Where there's a demand, there's normally a supply will follow. If you look at what's happened, and I'm fresh back from Las Vegas and CinemaCon, and from meeting with studios in Los Angeles after that, and the commitment to feature filmmaking right now with the legacy studios is unprecedented. Then when you actually look at the three biggest names in tech, Tim Cook, Jeff Bezos, and David and Larry Ellison, they've all now embraced theatrical releases and film production. They're coming into our industry.
Tim, at CinemaCon, ticket prices and premium formats, I know was a lot of the talk. Sony executive Tom Rothman was saying, movie tickets are just too expensive. Is he right?
I would agree domestically in the U.S. I think that there's a lack of creativity in pricing, and we, about 10 years ago, brought on pricing experts. And I think if you look at what's going on in Europe, particularly in the UK, it's a completely different pricing model. The industry was in the dark ages forever, and we've kind of brought it forward with dynamic pricing models. And we have entry-level prices for our customers who are perhaps suffering financially a little bit. We want to make it accessible for everyone. And it's a big difference. I mean, as you probably have seen, it hit $50 in the U.S. And, you know, for most families, that's simply not achievable, not attainable.
Are you expecting tastes of cinema goers to change a little bit? I mean, there's a, you know, will you see more European productions being shown in movie theaters, Japanese anime, Indian films?
In Europe, absolutely. I mean, we have the luxury here of having kind of domestic filmmakers. And in our markets in Europe, every single year, a handful of movies break into the top 5 or top 10. So we have a much broader audience and tastes in Europe than domestically in the U.S., where it's predominantly 85, 95% Hollywood. And if you look at what happened in Italy this year, Buen Camino, Cecco Zaloni's new movie, it passed C'è ancora domani, the last biggest movie in Italy, and then it passed Avatar, the highest grossing movie in Italian history. And what that actually does for European filmmaking, it's one of those classic success breeds success. It has shown other filmmakers and financiers of film that there is a market out there, and it's a great market, especially an emerging market now.
What have you seen as biggest change, actually, in your world in the last 10 to 15 years? I know, I mean, if you go back to The Devil Wears Prada, I mean, I couldn't open anything on social media without being bombarded, actually, with, you know, you see this with publicity and tours. I mean, is that what makes a movie successful? Well,
when you consider that Devil Wears Prada, the first one, was 20 years ago this October. It's extraordinary, and there's still this huge demand. There's a demand for great stories, and I think really the success of movies generally is starting with a great story. And Devil Wears Prada is a great story, and that has been well executed with great talent. But, you know, 2019 was the third consecutive record-breaking box office year. This was not an industry that was broken. We got hit by a pandemic. We got body slammed by a pandemic, and now we're back.
Talk to me a little bit about whether there's, you know, enough demand for alternative content, like concerts or sports.
Well, we did the very first kind of live concert with Genesis in 2007. And there is absolutely a demand, and we worked with Bernie Ecclestone, and when he was running F1, we ran F1 races right through. We've done Wimbledon. We did Wimbledon in 3D, and we learned about camera placement because a lot of our audience got sick because the cameras were too close to the net. Back and forth. But there is a growing demand now, and certainly for Asian films, Bollywood produces 20 times more movies than Hollywood does. There's a huge demand, and you're going to see some very, very big international successes with Bollywood movies this year.
Okay, what's your favorite film that I wouldn't have heard of that everyone should go and see at the moment? Do you have one? I'm putting you on the spot, aren't I?
I see so many movies. It is, I think looking forward, there's going to be some really interesting movies coming up that I'm really looking forward to. There's reboot and there's franchises, and even with Billie Eilish's concert movie coming out as well, James Cameron.
Tim, I mean, do you feel like you're a competitor to Netflix? I know it's a different experience, but again, because the content is king and it's everything.
Yeah, I started my career in home entertainment with the studios, so I've kind of seen all sides of it, and I've never looked at what happens in home as being competition with out of home. I worry more about theme parks and sporting fixtures than I do what happens in home.
So fun. Tim, thank you so much for joining us. Tim Richards there, founder and chief executive of View. Now, a couple of things we need to watch out for because it is a very big market today, and we've had a pretty big week, not only when it comes to central banks, but of course everything that's happening in the Strait of Hormuz. So quickly, U.S. equity futures pretty much steady. Maybe there's a bit of a pause in the rally that's put, Wall Street gauges to record highs. The other thing I'm looking for is yen resuming gains triggered by Japan's intervention, and then oil holding its second weekly gain as Donald Trump says he was sticking with the naval blockade of Iranian ports. Up next, it's Bloomberg Brief, and this is Bloomberg. Have a great weekend, everyone.